we're seeing central banks buying more gold than ever, and the central banks literally do not care what price they pay. And the reason for that is central banks are saying, look what's going on with the tariffs, look what's going on with Mr. Trump. We don't know which way he's going to jump. We have been friends with the United States, and we still are friends with the United States, but now they're talking about maybe giving us 100-year bonds at low interest rates in place of the 10-year treasuries we've got. And we might find that we've got no choice but to accede to that if we want to continue to keep our friendship with the United States. So the need to have more treasuries, I think, is falling away, and the need to have something else, and obviously it's gold.
The U.S. is floating the idea of issuing 100-year treasury bonds at historically low yields. To some foreign governments, buying these long-term obligations may soon become more of a diplomatic move than a financial one. And that's a dangerous sign for the credibility of U.S. debt. What happens when confidence is shaken in what was once the most trusted debt instrument in the world? We're already seeing the consequences. Countries like Japan have started to reassess their holdings. Hedge funds are dumping treasuries. Markets have seen unexplained sell-offs, adding to volatility and sending a strong signal.
And I would call tariffs an event which destroys value. Everything has to go down. That includes gold and silver. And we did see that in the early stage of the event. Stock markets, if you look at NASDAQ now, it's down 20%, and the Dow Jones or the S&P 500 is down, 14 or something percent. But how much is gold down? It's like probably less than 1% at the moment. So gold is holding up very, very well. I mean, it did have its dip, but it recovered fairly rapidly. And I think what's going on here is that there are big buyers out there somewhere who are saying we're going to have some allocation or more allocation to gold than we had before. Whether that's central banks or private individuals, or maybe it's a big country, perhaps. I mean, I'm going to throw one out there. How about Canada, who has no gold?
Hopefully Canada is buying gold. That's where I live. If they're not buying gold, then they're not thinking straight.
Yeah, well, I don't know if they are. I mean, obviously there's no information that they are, but I was trying to think who is, someone somewhere is taking delivery of high-value bars out of COMEX. And, so the speculation's been around. Is it the US government? Is it the Chinese? Is it Berkshire Hathaway? There's obviously some hedge funds involved. But, I'm thinking Canada, one of the best friends of the United States, is suddenly in a spat with the United States, and they're not sure if they can trust them anymore. So, now suddenly they're thinking, well, what are we doing holding all these US Treasury bonds? Is this the best thing? Shall we have some gold? So, I don't know. Maybe they're the gold buyer. There are people whose jobs must be at risk. And these people probably need to be conserving cash in case they fall on hard times due to the amount of imports going, that if they're outside the United States and they're selling their goods, or their company is selling goods into the United States, their job will be at risk, because when companies' sales reduce, it's only a question of time before they start to cut back on the staff, maybe 10% less staff. And you never know if you're going to be one of them. So those sort of people whose jobs might be at risk need to be conserving cash so that they can see themselves through a rainy day until they get another job. But there will also be those people who've got a lot of surplus wealth, and now we're going into recession. Well, what should they do? Are they going to have an opportunity to buy things more cheaply? Can they buy equities more cheaply? Can they buy business more cheaply? Can they buy property more cheaply? Can they buy gold more cheaply? This is a question. I mean, I think the way things go, we're seeing central banks buying more gold than ever, and the central banks literally do not care what price they pay. And the reason for that is central banks are saying, look what's going on with the tariffs, look what's going on with Mr. Trump. We don't know which way he's going to jump. We have been friends with the United States, and we still are friends with the United States. But now they're talking about maybe giving us 100-year bonds at low interest rates in place of the 10-year treasuries we've got. And we might find that we've got no choice but to accede to that if we want to continue to keep our friendship with the United States. It might be pushed on us. So the need to have more treasuries, I think, is falling away, and the need to have something else, and obviously it's gold, is going up. So I think that probably gold is well supported around these levels. Whether it's the sort of 3,000 level or 3,000 or 2,500 level, or maybe it will turn out to be a lot higher. I think it's well supported. So the risk is in my opinion, less than, for example, holding equities where there's a
Trust in U.S. financial leadership is faltering, and in that vacuum of trust, gold is stepping in. Take China, for instance. The People's Bank of China has added gold to its reserves for 5 straight months, with its latest increase clocking in at 0.09 million troy ounces. Gold now makes up 6.5% of China's total foreign reserves. Just a year ago, that number was 4.6%. This is no minor adjustment. It's a full-scale realignment.
Hoping, and I don't expect that we'll go into some sort of Great Depression. I do think we'll have a recession. We're going to see globally higher prices. I think central banks are going to look at those and say that's a one-off. It's not part of the underlying inflation, so it has to be disregarded. So we won't take into account the rising prices as part of our policy of keeping inflation down, because in a year's time, this one-off impact of higher tariffs and so forth will be out of the system. So, but obviously we are going to have all around the world, people will lose their jobs due to the tariffs at both ends, both due to the American tariffs on foreign goods and the retaliations by foreign countries. Switzerland, which is one of the many countries which has been accused of having a trade imbalance with the United States, Switzerland is supporting slightly over 1 million jobs in the United States through its imports and its services, which it buys from the United States.
Okay.
And the United States is supporting slightly less than 1 million jobs in Switzerland through its goods imported. It imports gold bars, it imports medicines and watches and all kinds of things and services from Switzerland. So USA has more jobs supported by Switzerland than Switzerland has supported by the USA. Yet I'm looking at that number, and where Switzerland is being accused of having a huge trade imbalance. But of course, what they're looking at is the imbalance in physical goods, because in fact, it's true that America buys more physical Swiss goods than Switzerland buys physical American goods. But when you look at the services industry, Switzerland buys a lot more services out of the United States than America buys from Switzerland. So those two balance out. They both come to a very, very roughly $80 billion each in each direction. So now Switzerland hasn't imposed any retaliatory tariffs, but certainly it does mean that, and I take our country as an example, Switzerland, it does mean that some people are going to lose their jobs here because America will be importing less than they used to. And that applies to just about every country in the world. People in America are not going to pay higher prices if they don't have to. So they'll be looking around and seeing where they can buy, if there is a competing American product, they'll be looking around trying to find out where they can buy that competing product. So yes, internally, it's going to be good for America up to a point, because some American businesses will be able to put up their prices because the demand will suddenly increase. But other American businesses will suffer greatly because most of what they make is imported from abroad. So if you're manufacturing, if you're in the motor car industry or building computers or anything, you're buying components and stuff, or tractors, doesn't matter, whatever you're buying components from all around the world. And as they come into the United States, they're going to cost you, the importer, a lot more. And that means that your profits will shrink, and some businesses will go out of business and some will report lower profits, and there'll be very, very few who will report higher profits because they make everything inside the United States, and the competing foreign product isn't coming in quite as much. So I think in a way we go to a situation where overall prices will rise, and over time people will lose their jobs. The unemployment rate, I think, will rise because of this, not only in the United States but globally, and that basically means we'll go into some sort of recession, and we'll see lower profits from companies around the world, and that will mean most likely lower equity prices for a while. As for gold and silver, a lot of we've seen how well it's held up in this recent market debacle. It's almost down nothing, and I think that asset allocators are now looking at their portfolios. They're saying, as they do all the time, they're back testing the different asset allocations, and they're discovering, when they do these back tests now, they're discovering that had they had some gold in the portfolio it would have improved what's called the Sharpe ratio. The Sharpe ratio is a measure of risk and reward for a particular type of portfolio, whether it be a growth portfolio, a balanced portfolio, or a defensive portfolio. You want to have the Sharpe ratio at the best level. So they'll found that adding gold to the portfolio will have improved the Sharpe ratio. It will, in other words, it will have reduced the volatility and it will have increased.
Clive Thompson also raises an intriguing question. Could countries like Canada, which currently holds no official gold reserves, be quietly re-entering the gold market? With diplomatic tensions rising between longtime allies like Canada and the United States, it's not out of the question. As trust in the U.S. Treasury weakens, more nations may look to gold as an alternative store of value, one that isn't subject to political pressure or dollar-based debt deals. Thompson even speculates that some of the physical deliveries of gold from COMEX could be going to sovereign entities or massive hedge funds. Names like Berkshire Hathaway are floated. And while no one can say for sure, it's clear that someone somewhere is quietly accumulating physical gold in large volumes. Meanwhile, as equities slide, gold has remained remarkably stable. The Nasdaq is down 20%, the S&P 500 is down 14%. But gold has dropped less than 1%. That kind of performance in a volatile market doesn't go unnoticed. Portfolio managers are taking a second look. As they backtest different allocation strategies, many are finding that gold not only reduces volatility, but also boosts long-term returns. That's reflected in improved Sharpe ratios, one of the key performance metrics for managing risk and reward. But this shift isn't just about returns. It's about safety. And it's about trust. Looking at the broader macroeconomic picture, Thompson sees a global recession on the horizon. He stops short of predicting a depression, but warns that rising input costs and inflation driven by tariffs will affect industries worldwide. Central banks, he says, may see this inflation as transitory, a one-time shock due to trade disruption, not the start of an ongoing price spiral. Still, the impact will be real.
Jobs will be lost. Businesses that rely heavily on global supply chains, like car manufacturers, tech firms, and industrial producers, are already feeling the squeeze. Margins are tightening, costs are rising, and profits are falling. Even countries,
like Switzerland, often seen as neutral in trade wars, aren't immune. Though the U.S. accuses Switzerland of having a trade imbalance, the numbers show a more complex reality. Switzerland supports over 1 million jobs in the United States through trade. But as U.S. import volumes drop due to tariffs, jobs on both sides of the Atlantic are at risk. Domestically, the American consumer will also feel the effects. While tariffs may help some local producers temporarily, many American companies rely on imported components. When those prices go up, profits shrink, and eventually jobs are cut. Thompson believes we'll see higher unemployment globally as a result. And that will feed into a broader economic slowdown, likely bringing equity prices down further. For investors in stocks, the next few quarters may be especially challenging. But for gold and silver, the story could be very different. Gold is holding its ground. Silver remains volatile, but is following gold's general trend. And the deeper message is this: trust in fiat currencies and debt-backed financial systems is being questioned like never before. As institutions large and small reassess their exposure, gold is no longer seen as just a hedge. It's becoming a core component of strategic reserve management. From central banks to family offices, there's a growing movement to return to tangible assets, those that can weather political storms and financial uncertainty. So, what should investors watch? Track central bank activity closely. Monitor the gold accumulation trends from countries like China, Russia, and potentially even Canada. Stay alert to treasury market volatility, and ask yourself, where do you want to be positioned if the global trust in fiat systems continues to decline? This could be the beginning of a new monetary era, one where gold reclaims its place, not just as a store of value, but as a foundational asset in the global economy. That's your Global Market Watch update. Share your perspective in the comments. Are we witnessing the decline of the dollar's dominance, or just a temporary shift in strategy? If this report gave you insight, make sure to subscribe and hit the bell icon to stay informed as the global story unfolds.